All right. Good morning, everybody, and thank you for joining us today. Thank you to Caroline and Matt for being here, and thanks to our clients who managed to find some time on a Friday to hear us out in terms of what's going on. I'm not sure we have all the answers, but yeah, thanks so much for being here. Everybody knows who I am, and hopefully you know who these two people are, your PMs, Matt and Caroline. Something you may not know about them. Caroline's been doing this for forever, not really forever, but 25 years, and Matt for 12 years. Right? So, you know, there's a lot of experience. Caroline always tells us, you know, it's not the first time she's seen this. Don't worry, sit tight. So yeah, that comes with being in the game for that long. The topic this morning is you know, WTF, what's going on in my portfolio. Markets are all over the show, up, down, left, right, and it's really hard just to keep track of everything, right? To keep track of the noise, the movement, and look, as you should know by now, markets aren't my area of expertise. I do the planning stuff, and then we bring in these guys to sort of manage the money in the long term. So I rely on them, and what you'll get to hear this morning is that it's not just them. They don't operate in isolation. There's a team behind them. So we're going to get to know what the team is doing, what they typically do in a time like this, what's going on at the moment, and see how they are positioning themselves for what's happening and what they anticipate to happen. So just before we get started, we're going to keep it interactive, informal. Any questions? We've got a couple of questions that have come through already. But if any pop up during the presentation, we'll address those guys. We'll try to keep some time at the end to address any other questions. Yeah, no PowerPoint. We may bring up one or two slides just to appease Caroline, and you know, she does have one or two slides that she likes to show just to drive home a point. So we'll let you do that. But it's just an informal conversation between the three of us and you, addressing what's actually going on, right? So guys, again, thanks for being here. And yeah, that being said, I think let's jump in, right? Maybe we can just start with a quick recap on the markets. You know, what's actually going on? What's driving all these losses at the moment?
Well, good morning, everybody. Good morning, Mark. Morning, Caroline. I think, yes, we sort of take a step back and cast our minds back into the beginning of the year, which was really where the market turmoil started off. And probably one of the significant points at the beginning of the year was the Russian and Ukraine crisis, which I guess was the point that sticks in my mind the most, is when we saw a bit of an inflection point in the markets, and the market's really starting to settle off and what that has done. And I guess it kind of accelerated, in my mind, inflation and put inflationary pressures into the markets. You know, you saw a spike in oil price, you saw a spike in commodity prices, soft commodities, all around that sort of crisis. And really what that did is potentially valuations were looking a little bit stretched at that time, and this provided a catalyst for this market to come off, which we've seen the market come off, you know, with the market sort of entering bear territory. You know, market's down about 20% year to date, and it's largely on the back of that. Now, the Ukraine crisis sort of might have now, it's not in the forefront of news at the moment, but that did start off the market turmoil. And on the back of that, then we saw the inflation increase, and naturally then the US started increasing interest rates, and higher interest rates, higher inflation in the globe is bad for equity markets. So that's what we saw.
Was the inflation story around before, and the sort of Russia-Ukraine war just added fuel to the fire, to say?
It probably brought it on a bit quicker. You know, it accelerated everything. I sort of feel that the Russian-Ukraine war, I mean, with markets reopening after COVID, you know, that didn't cause a little bit of inflation, but the Russian and Ukraine crisis probably added fuel to that fire. and accelerated all of that.
Karen, can I just bring you in here? Why is the rising inflation bad for equity markets, right? Why is that an issue?
So I think there's two things about inflation that is driving the equity market. First of all, you've got to remember it's an emotional issue. The average European or American has for a very long period of time are used to close to zero rates. So when you start to see inflation increase, there's almost this knee-jerk reaction because it's uncertainty, and markets just don't like uncertainty. Where it is bad for the markets, it really, you've got to look at the developed markets. These are largely consumer economies. So they do need, the consumer to start purchasing. They need the consumer to use goods, services, buy things to actually, to keep the economies running. When things start to get more and more expensive, you see that start to pull back, then you start to see recessions happen. I think the really obvious example right now is if you look at what's happening in Britain. And, you probably see, the oil and the gas crisis, is just, raised the level of the energy costs. It's already having an impact on people's balance sheets. People are struggling, to choose between childcare, and luxury foods. So it's an immediate impact on people's pockets. People don't spend, consequently, companies don't produce as much, and it just leads to an overall slowing in the economy.
Okay, so rising costs, less money for the discretionary spending, money for the consumer who can't go out and actually buy all the goods that they ordinarily buy. So that makes logical sense, but logical sense doesn't necessarily drive the equity market, right?
No.
Supply and demand makes sense theoretically in the textbook, but there's some more going on in the background, I assume.
Yes, so definitely. I always say that it's very rare that the equity market is a good reflection of the value of a company. More often than not, it's hugely overvalued, which we saw at the end of last year, or it's usually undervalued, which is probably what we're seeing now. A lot of what drives that is sentiment, consumer sentiment, purchasing manager sentiment. If people are negative, that usually at the same time, that usually leads to a market downturn below where it probably should be. It should be at any point in time. And right now, people are negative. Probably the biggest reason for that is what we say is market uncertainty. People get worried when they don't know what's going to happen. People are worried now because they don't know, have we reached peak inflation, or is there going to be more inflation down the line? Investors are worried as to, how this commodity price increase, this energy price increase are going to actually, how long it's going to extend for. Is it going to carry on to the end of the year, or is this a 2, 3, 4, 5 year thing? What is the world going to look like then? People don't know how often, central banks are going to raise rates, how much they're going to raise them by, and when they're going to raise them. And I'm not even sure that central banks have a good idea at this point of how they're going to do that. So all of that just leads to market uncertainty, and it leads to volatility as well. And volatility is never good for the market. If you have a look at, and there are indices offshore that you can actually measure volatility, and you've really seen that since the end of last year, the volatility indexes have just spiked. But that also doesn't really give a good indication of what happens intraday, because if you have a look at your portfolio and you look at the market, on a particular day, you might see the portfolio is up 1%, the market's up 1.5%, and the next day it's down 2%. That doesn't, if you really look at what happens in the market overnight, and especially some of the shares on your portfolio, there are really wild swings. And by wild, I think, it can be about between 5 and 10%, sometimes in the session, which is hugely, is really, really very unusual for the large caps. So it just shows that people, it is all over the place at the moment, and we're going to have to wait to see, how inflation is playing out, how the US Fed, the ECB are actually going to deal with that before people start to get comfortable. People are not comfortable right now.
Okay, so that makes sense. And it sounds like a lot of what you're talking about is in the global market, right? So how does that translate into our local market? What's going on here?
Okay, so Matt.
You're up.
Yeah, so I mean, we're suffering from many of the same problems as the global market. I mean, inflation in South Africa is ticking up. Oil price impacts us. I mean, we're an importer of oil, so we see that impact coming through. So we have sort of the same impact as here. We've got rising rates, rising inflation. But from a market composition point of view, where we are very different, is that we have quite a lot of resource companies listed relative to other companies. And the resource companies, because resource prices have performed nicely over the last couple of years, they've done well. And that's by and large supported the JSE. So the JSE has actually performed relatively better than the developed markets. Another similar market to us in sort of composition is the UK market, the FTSE. I mean, they've also got quite a lot of resource companies. So this has done well, where the tech names have pulled back. But from an economic point of view, because South Africa is so small, when the US increases interest rates, when the globe increases interest rates because of inflation, it does fuel our inflation. I mean, higher oil price will flow through into our economy as well, and we will struggle from that point of view. But the JSE, from a market point of view, has been relatively protected in this sort of environment. We've kind of benefited a little bit from it relative to the rest of the world.
Okay. All right. So now that we've got a brief understanding of what's going on, inflation, Ukraine, oil prices, what is going on in the AdviceWorks office, right? What are you guys doing behind the scenes? Is it just Matt and Caroline, or who sits behind you? You know, one of my clients always used to refer to you guys as the clever guys in the back office. Like, who are the clever guys in the back office, and what does that look like? What are you guys doing? Can you shed some light on that, please?
Well, we hide in the cafeteria, I think. No, look, the reality is it is a very big team. You know, it is not just us. And if you think about it, there's concentric circles moving out. You know, you've got your portfolio manager who sits within an AdviceWorks investment team, who sits within an Old Mutual investment team, who sits within the broader Old Mutual research group, and then you've got external research coming in. So if you start from the outside going in again, you get external research from a number of different places. You know, we'll get them from JP Morgan, you know, there's a couple of other research houses. You know, that comes into all of us, but, you know, specifically then gets dealt with by the Old Mutual investment team, it's a very, very big team, and they work together with the economists and econometrists at the multi-asset managers who determine the asset allocation on your portfolios. Coming in, then Old Mutual Private Clients has got their own internal team. We have meetings with the entire team once a week. AdviceWorks. Yeah, this is the entire Old Mutual team. So once a week. The AdviceWorks investment team then meets more frequently as necessary. You know, we'll discuss individual shares on our portfolios, or we will discuss the economic climate and how we're going to, you know, balance portfolios. So there is, you know, there's an enormous amount of discussion going on, and there's constant communication. I would say that it's not out of the normal, you know, for what we do. We didn't suddenly kick into this mode because we have a financial crisis. We all do that. But there's obviously a lot more communication now because, you know, things are really happening so quickly. You know, you saw overnight, you know, we saw when the ex-Japanese prime minister was assassinated. We saw Boris Johnson being politically assassinated yesterday.
Yeah.
You know, so obviously those types of things, you know, do require a little bit more discussion. So, yeah. So I don't know if that answers your question, Marc.
Yeah, I think just to add on to Caroline's point there, you know, we are always looking at the market. So these meetings, you know, in good times and bad times, you know, we meet almost as much as in the bad times as in the good times, because there's always something to look at in the market. So it's not like all of a sudden now, you know, we panic and we have, you know, immense amount of meetings. You know, our processes are in place in the good times. So when the bad times struck, you know, our investment processes and our philosophies still remain true, and we still honor them in times when we're struggling in the markets. So those processes still carry on.
Yeah, so it sounds like there's I love processes, right? So there's a process that happens on a monthly, weekly, daily basis. Well, maybe not daily, but I guess daily in terms of information. And that process is stress tested in good times and bad times. So, you know, it's going to do its job when markets are running, and it's going to do its job when markets aren't running. The bottom line is it's doing its job. Nobody's operating in isolation, and the universe extends past you guys individually, past the AdviceWorks office, into the old mutual office, and into the greater old mutual office, right? So it sounds like there's a lot of knowledge floating around, right, and being shared.
Yeah, I think if I speak for myself, and Mathew's probably the same, you know, probably about 2.5 hours of my day is just actually spent reading, you know, the research that you get hit with a lot of good data.
Okay. All right, cool. So let's maybe jump into the global side of things. Let's look at our global portfolio stock composition, and we can maybe just have a chat as to what's going on there with the actual portfolio. Is it selling opportunities, buying opportunities, holding, and what's going on there, guys?
So, Matt.
Okay, so you know, as Caroline sort of alluded to, she put it a lot better than I'm going to put it, but you know, the price of a business is not necessarily reflective of the quality of that business, and that's something we try and always remember. You know, these businesses that we buy in our global portfolio and our local portfolio are very good quality kind of businesses. In times, we often stress test the businesses and see what we want for various economic conditions. So if we look at, you know, we've now got sort of a rising inflation in inflationary environment. What businesses or companies would we rather be in a rising inflationary environment? Businesses we don't want to be in a rising inflationary environment. So rising inflation, rising interest rates. So typically in this sort of thing, what you want to be in is where you want to have a look at is companies that make high margins, you know, good operating margins, good net margins, because the higher the margins your business has or the business you invest in, the easier it is for them to absorb any impacts. So if people buy less, they can reduce their prices, you know, and they'll still be selling at a profit, maybe not the profits they made last year, but still selling at a profit. So they are able to absorb a lot of shocks. So when this crisis went, when we started first thinking about higher inflation at the beginning of this year, you know, the research team, which was headed by our Chief Investment Officer, Andrew Dittburner, they went in and they delved deep into every company's profit margins, and we came out and we found that over our portfolio, the portfolio has higher operating margins in the rest of the market. So that gave us some comfort that in a high interest rate environment, you know, other businesses that we invest in have higher operating margins. Another thing we sort of look at is high debt levels. You know, you don't necessarily want a business that has large amounts of debt, because high debt, you're going to have to finance that debt, you know, and high interest rates, it's going to cost you a bit more. So you don't want businesses that are highly indebted in this sort of environment either. So those are sort of the first two things that we looked at in that sort of environment. And then we made some changes on the back of that in the portfolios.
Yeah, I was going to say. So looking at that, did you find some companies that weren't as profitable as you would have liked, or were slightly more indebted given the circumstances that you would have liked, and what did you do?
Yeah, so I don't know so what we found out in that sort of state is that because we invest in good quality businesses, you know, our businesses tend to not have a lot of debt on their balances, and they tend to have good profit margins. There was one sort of little red flag that came up, which was Starbucks, which has, you know, lower profit margins because of just the nature of the coffee business. You know, they're faced with higher wage inflation. You know, they employ quite a lot of people. They got to try and somehow absorb that into their business, and they sit with a lot of debt. So Starbucks was the one that we looked at, and we sort of, you know, there was a question mark around Starbucks. And then sort of you say, well, you know, if you're sort of exiting or thinking of exiting Starbucks, what company would you like to add into the portfolio? And we had to look at something like an Apple. You know, Apple sits with sort of $80 billion on the balance sheet in cash, you know, because they don't have debt. You know, it's such a good brand that you'd expect it, you know, over the long term to ride out sort of any sort of cycle. You know, you might sell a little less iPhones this year, over the sort of the long term, that trend should normalize somewhat. And also, if you sort of look into their services business, your Apple Music, your iCloud, that sort of thing, there's potential for quite a bit of growth there in that business as well. So that's sort of the sort of things we look at is saying, maybe it's time to sort of exit something like a Starbucks, and is there something better to put into a portfolio in a time like this? But generally, it wasn't a need to make massive changes in our portfolio, because as businesses, we look at them and we put a hat on and say, in 3 and 5 years' time, where are these companies going to be? And they're still solid, good businesses. That we don't think we need to make any sort of massive knee-jerk reactions in times like these.
It sounds like the lens that you ordinarily look at these companies on rings true regardless of what's going on in the markets, really, which should give some comfort to know that that's normally how we approach things. We just need to relook at it in times like this, I guess.
Yeah, I think also, from my side, if we've got to, take the chance that we are sitting in a recessionary period or going into a recession potentially. So you also look at things that, that are vulnerable to the consumer just stopping buying them, and a 40 Rand or I don't know how many dollars cup of coffee, is is probably a sitting duck for things. And then, but also from a buying opportunity, you might see on your portfolios, what you have seen, if you're that Disney hasn't done particularly well. And we've added to our Disney position recently because even though it is a consumer discretionary stock, there are a lot of things actually in its favor now. It has a travel, section with its parks. With COVID opening up, people are suddenly traveling more, despite the fact that there's a risk of recession. But also, they have a fantastic, apart from the Disney brand, they've got a streaming service, which is now seriously starting to compete with Netflix. And, we even see it in South Africa, people don't tend to switch their DSTVs off immediately, when they're running out of money. It's almost like the last thing to go. And, so it was just such a fantastic franchise. It's a company, I think what we really look at when we look at companies, I think the first thing we ask us is, will this company still be around in 10 years' time? Will it still be profitable? And will it still have good margins? And, when you look at this type of company, it ticks all of those boxes. So, right now it went on sale and we take the opportunity.
Okay, so we have to address that, right? So you guys held Disney originally.
Correct.
It's lost, I don't know how much, but it's lost a bit of value, right? But looking forward, you still think that the business is going to be able to continue to make money? It sounds like it's evolving slightly. I remember you guys in the beginning talking about Disney as the theme parks and all of that stuff, but this evolution in terms of the streaming and additional revenue streams keeping up with the times. Still opportunity for growth into the future, right? And like you say, now it's on sale.
Absolutely.
That makes a lot of sense. Any companies that you guys have gotten rid of? So Starbucks, which makes sense, right? So we were in Portugal, and people here love coffee, right? But they love the coffee from around the corner shop cafe. And the price difference, so for us, South Africa, we're used to drinking big coffees. In Portugal, they drink like a little cafe. It's like even smaller than an espresso. But, and it's cheap. It's like less than half €1. I don't know. What is it? It's like 10 Rand, right? Less than 10 Rand. But you go to a Starbucks and we're like, oh, Starbucks, we can go get a big coffee. But the prices are high, right? And I think people are when they're put under the pump, they're going to make decisions about, do I pay 10 Rand or like €0.5, or am I going to pay like €3 just for a Starbucks branded coffee? And if there's no money in your pocket, you know what you're going to do, right?
Mm-hmm. Correct. Yeah. People still kind of, at the beginning, when there is a slowdown and people have got less money in their pockets, they immediately do start to, look for cheaper ways of doing things. If I look at our local portfolio, for example, we don't have Woolworths, but we do have Shoprite. We haven't had Woolworths for a while because it really is a case in point. But if I look at myself, you walk into Woolworths, you get an enormous shock. You get a bigger shock every time you walk in. That business is just ripe for down trading. Now I go to Checkers instead of, Checkers, Shoprite instead of Woolworths. So this is the type of consideration that we take. And we haven't had that Woolworths for a while, and we've had Shoprite for a while, because again, we don't look at what's happening now. We look at what's potentially going to happen going forward. And we've actually been particularly lucky in South Africa up until this point, is that, the economy hasn't been as bad as it could be, all things being equal. We've had a very, very good commodity cycle. The tax revenue that government has been collecting has been better than expected. But, we're always teetering on, real economic downturn here. And, when you see South Africa's employment stats, it looks very, very dire. Yeah. And we're going to have a problem also if the commodity cycle turns and things start to slow down, especially if the world slows down. So a company like Shoprite is a definite beneficiary of that, and Woolworths is not. So these are the other decisions that we take. Both quality companies, but one is safer than the other.
Yeah, I think if you look to the future, you can actively see people not shopping at Woolies Food and going to Shoprite. Shoprite and Checkers, it's the same thing,
Same business,
because they've made a massive revamp of their business. So it's kind of competes with Woolies quality. I just think the prices are quite a bit lower. Is it insulated in that if things don't recover in the South African market, people are going to downgrade from Shoprite? What is the downgrade from there? Or is that kind of, we're not really going to, I don't know what you go to outside of Shoprite?
Yeah, so it is insulated to an extent. It is relatively insulated from the bottom up. So these are the lower income, the middle lower income. Also because there are a lot of government grants, there, and people still need to buy food. People still need to buy their cooking oil, their maize. The problem with that is that these tend to be quite low margin things. Low to no margins. The rest of the company, certainly, there is going to be absolutely no company that is not going to be affected if we have a serious economic downturn. People, margins are going to be lower across the board. Unless you're a debt collection agency, you're not going to make a hell of a lot of money. But so this is where the selection of the company is important. We want to know that even if those margins turn down, exactly like Mathew said, that there is still going to be a margin. And there is still going to be earnings. So yes, in Shoprite, there is still going to be a margin because they are a price setter, not a price taker. Food producers need to negotiate with them to get their products on the shelves, number one. And number two, all of us are still going to need to eat. We're still going to need toiletries. We're still going to need cleaning materials. And this is where the resilience of the business comes in. Also, the quality of management is very important, because you want to see a management that really has a consistent profile. And if you look at the quality of that management and watch, if you just walk into those stores and you see the changes that have been made in the last few years, you just get an indication of the type of people you're dealing with, which is also very, very important to us when we make a selection.
Okay. Matt, I want to ask something. At the local portfolio, so I've seen some communications that you've sent to clients about you guys potentially exiting out of CECIL.
Yes.
I've also seen CECIL over the last 2 days has had an amazing bump, right? I think yesterday it was up 10%. I think it was like 5% the day before. So what's going, Caroline? You're on
Sorry.
What's going on with CECIL, right? Why is it running now? And why do you guys want to get out of it?
Yeah, so CECIL is not part of our house view. It hasn't been for some time, but certain clients do hold CECIL that have liked CECIL. But if you look at sort of CECIL as kind of a business, and where oil price is sitting at the moment, where was it in the crisis? I mean, there was a very real reason that CECIL was going to zero and that business would. And, you know, when the depths of the COVID-19 crisis hit, I mean, there was a very, very real chance with the amount of CECIL's debt it had that CECIL wouldn't exist, you know, in a few months' time. And the oil price after that bounced, and that sort of supported CECIL. So CECIL really is just based on the oil price. I mean, that business is what the oil price is. CECIL is where we're sort of looking at oil prices at the moment. I mean, there are some views where there's quite lofty valuations for CECIL, sort of 600 Rand a share. I sort of am a little bit skeptical of that, given that we're seeing oil prices now sort of, let's call it $100 a barrel. And if we are to see some more slowing in the global economy, I struggle to see any reason why, if we see slowing in the global economy, why the oil price would appreciate substantially from it where it is now. Because, you know, slowing in global economy, you're going to use less oil. So from that point of view, you know, I guess I'm trying to say is that I don't think we're going to see another sort of 80% or 50% move in the oil price from these sort of levels. I mean, I could be wrong, but if we are going to see a slowing in the economy, it's very unlikely that oil price is going to accelerate from this sort of level unless supply gets cut for another sort of reason. So from that point of view, I think, you know, where CECIL is now, it was an opportune time just to exit it.
Just in terms of the debt, so you're saying CECIL sits with a lot of debt. With this bump or the recovery for CECIL, have they been reducing that debt, or is it still there? You know, it's just oil is at a much higher level, so it's inflating their prices. So that's still an underlying issue.
Yeah, their debt is still there. I mean, their new management has gone some way post the oil shock in the COVID crisis to sort of realign that business, try and reduce some of their debt. I mean, their debt largely lies in their US operations, but they have gone some way in trying to reduce that to make it a bit more future fit for an oil price that potentially could be a lot lower going forward.
Caroline, anything to add there?
Yeah, I think, you know, if you look at the energy market as a whole, and CECIL is unfortunately not been a very well-managed company, you know, so just really from that point of view, it's never been attractive to us. You know, management is one of those that seems to lurch from mistake to mistake to mistake. But, you know, that, you know, and the question then arises of clients is, why didn't we have another energy company on our offshore portfolios? So then I would suggest, you know, rather go and look at the oil price long term, you know, so don't look at it over the last 6 months, look at it over the last 5 years. And you'll probably find that, you know, where you started, you're pretty much where you're ending. You've just had a few heart attacks up and down in between. You know, this is not necessarily something that is, like Mathew made a very big point, is it's not something that's going to continue into the future, especially if we go greener as we are going greener. And really it is likely that this current oil crisis that we're seeing, you know, there is, you know, I think governments have really realized now with shutting off Russian gas and oil to a great extent, is that you cannot rely on some very dangerous parts of the world to keep your lights on. You know, so there is going to be a long-term trend where you move to energy, you know, production that is not oil-based. So it's not a long-term story. That said, you know, there are companies, oil producers overseas who do produce, you know, very, very good dividends. And they're very high dividends, especially in this time, you know, because they're reaping the benefits of that high oil price. But, you know, they are sitting ducks, you know, for governments wanting to charge a windfall tax. So you've also got to be very careful about going into those companies, say, well, I'm going to earn an 8% yield, you know, when you've already got governments across the globe. You know, if I look at the UK in particular, already targeting, looking to target these guys, you know, to take a portion of those earnings. So again, a risky proposition, as are all commodities.
Okay, so given what's going on in the world, where do you guys and the team see opportunity going forward?
Mathew.
I mean, I guess it just changes. It's a good question, Mark. And in times like crisis like this, you often, when markets are down, you think there are no opportunities in the market because the markets have fallen 20-odd%, and it's almost, it's very negative. I don't know if it's peak negativity yet, but you're very negative on the whole market. So then what I try and do, and I think what we all try and do, is you try and like take a step back, put a long-term hat on, get back to your investment philosophy. So where are these opportunities? And if you put a long-term hat on, and you again, your 5-year hat, your 7-year kind of view, it still kind of leads me to the tech space, these tech businesses that are still good, they're entrenched in the markets, over a long term, there's probably some very good opportunity in those sort of spaces. Healthcare is another one. We've seen the healthcare sector sell off as well of late. But over the long term, that's also, probably where there's some opportunities lie. It is peak negative, there's a lot of negativity in the market now, but you've got to try and put that away. And then if you look at sort of the valuations and the prices now, well, then there's quite a lot of opportunity out there as well, I can't tell you if the market's going to get worse or better. I mean, we just don't know. But it is looking, 20% down. Is it going to fall another 20%? I don't know. But at this stage, it's 20% cheaper than it was sort of a year ago. And we all know over the long-term markets trend up. So that's what sort of...
You're looking at tech into the future. It makes sense, I guess. And the same sort of players, the big guys, Apple, Facebook, Microsoft, same sort of big blue chip companies, or anybody else. And on the medical front, is it, I don't even know the big international names there.
Yeah, so, sort of your medical side of things, you've still got your medical device manufacturers, where the two in our portfolios, Danaher, Medtronic, which we like. I mean, there's Johnson & Johnson in the portfolio. We've got a biotech index in the portfolio as well. So that all plays to the medical side of things. And the medical is just basically based on that, through technology, medicine gets better and better. People live longer and longer. And as people live longer and longer, you need more medicine. So it's like a snowball effect there, those businesses sort of face, which is great. So that's quite a nice annuity income that these businesses sort of generate. And then, the tech side of things, yes, it is generally the big tech names. The problem with some of the smaller tech names is their valuations get stratospheric at some stages. So you tend to go for the big tech names, but there is, other opportunities in tech that you can have a look at going forward, in sort of cybersecurity and that sort of things. But you've got to just be wary on sort of your entry levels into those sort of businesses, and for certain clients, because they are extremely volatile kind of businesses.
Caroline?
Yeah, so I'd also say, in times like this, you've also got to be careful about going for some of the smaller players, so it's very tempting to say, look, there's value, mid-cap, are actually going to do better than some of the big guys. What I have found from, the decades of experience is that when you have an event like this, is that there's the bigger guys going in are bigger going out, and a lot of the smaller players have disappeared. And there's really two reasons for that. Number one is that their valuations go down. So, they're almost sitting ducks to be taken out and bought out by one of their competitors. The number two is they don't often have the same margins and the same cash flow generation as an Apple or an Amazon, for example. So, when things do start to wobble, or when the downswing lasts longer than expected, again, they either get acquired or they just fall away. So I think it's going to be interesting if you just take a list of stocks that are in the tech sector now, put that away somewhere, and then look at them again when we come out of this crisis, and you're going to see it's going to be a lot shorter list. Okay. And again, the bigger guys are going to do better over the period.
One of the names, I think it's that gaming company, Envision, or that I think Microsoft
Activision. Yes.
Didn't they do like incredibly well for a while, and then something went wrong, or that's an example of what you're talking about, right?
Yeah, so Activision has, it's really one of those things, management. They've had, I think it was, there was sexual misconduct, harassment, stories floating around them for a very long period of time. Now, those are damaging in themselves, especially from an institutional investor point of view, because, institutions really do focus a lot on your environmental, social, and governance issues, especially offshore. So it looked ugly from that point of view. But then it also, does those types of events, when they carry on at a company, it's usually a sign that there are other things wrong. So despite the fact that, and frankly, all of these companies, did very well, and their outlook, going forward is very good, despite where the price is. You do need to make a change at a company like this. So, Microsoft has made a bid for it. A lot of people say, is it worthwhile actually going into Activision Blizzard now, considering the fact that Microsoft is paying a nice premium. I haven't looked at the price later, but it was initially offer was at a premium. But then again, you're taking the risk that the deal doesn't go through. And especially, overseas, regulators are a lot more aggressive about antitrust and things like that than they are here. So, the deal might not yet come through, in which case Activision Blizzard is back to the drawing board with the same management, which, institutional investors don't really have a lot of confidence in.
I think something that's coming through for me that I've never really quite got my head around through this conversation is trading versus long-term asset management, right? And you guys have always said, we want to look at management teams and see how they're doing and buy into management teams. And I think that's, in times like this, it's proving to be an effective method to protect yourself, right? So a trader would really just look at prices and levels and buying and selling based on market movements and sentiments and things. But in terms of long-term asset management, you guys are looking into the company, right? I don't think we ever held that Activision stock, but I know a lot of companies did hold it. And when it was running, they were singing from a different term sheet, as I'm assuming they're singing now. But looking into the management team in terms of what they're doing, what they're not doing, what the long-term future is, it's quite comforting knowing that's the process that actually happens in this sort of portfolio world.
Yeah, look, it is extremely important. First of all, just from a moral point of view, you don't want to be involved with somebody who's particularly ugly. But, if I look back, through my years, there were usually, when things go backwards, there were usually warning signs. And, it's sometimes very difficult, especially when you've got these celebrity CEOs and they're very charismatic. I'm thinking Steinhoff, for example, and the market is loving them and it's pushing the share price up. Sometimes, you feel very compelled to put your misgivings away and ignore it. And the unfortunate thing is, a lesson we learn over and over again is that it's never a good idea. You've got worries about a person. There are hundreds of other investment opportunities that you take. But then again, even though you go into that much depth, sometimes you can't actually see it coming. And I think a few years ago, I think a great example was Volkswagen, and their emissions scandal, cheating on emissions tests. If you looked at the management thing, you look like a whole lot of very conservative Germans. You just don't know what's going underneath. So it's not a foolproof method, but it gets you a fair, gets you a fair distance, keeps you out of trouble more often than not.
Okay, so another question. Given what's going on in markets locally and abroad, is this a buying opportunity now, or do you wait some more? Do you pick up little bits and pieces? What are you guys doing now with new money in existing portfolios, or just new money altogether, right?
Yeah, so I think this is probably going to be dependent on the portfolio manager. So we can each have a go on
this. We got two of you.
This is why you're not buying into a fund, mutual fund. You are buying into a portfolio manager. From my point of view, I'm a little bit cautious now. And the reason I'm cautious is, like I spoke to you about the volatility earlier, and the fact that people are really uncertain as to which way the Fed is going to go. So, I do see things looking very attractive. I've got cash on the sidelines. I would love to buy some of these prices, but if anything, I'm phasing in. If I have to, so take a little bit of the cash, buy some, and then wait a few weeks, potentially buy some more. So that is my approach.
What do you think?
Yeah, so a very sort of similar approach. I mean, with if you have cash, you'd probably be looking to phase it in now. I'd be reluctant to keep it all in cash because I don't know, can't call the marks. I don't know if this is the bottom or if we're going to wait to have some more pain, or if the bottom's going to come in 6 months' time. We just don't know. So it would be a phased in approach to buy a bit now, a bit in a month's time, and a bit in sort of 3 months' time, or whatever the case may be. It's generally a discussion, that you take with the client as well, and it comes down to almost how much risk that particular client is also willing to take, because you could get a client who's got a high risk tolerance with the new money and says, 20% down the market, I'm going to invest for 10 years. I'm a young chap and I'll have it, for the next 15 years. Let's look at this as a buying opportunity and put it all in now, sort of thing. And I'll chat to you in 10 years' time, and the markets would have naturally been out from here. But then you get a client who's maybe doesn't have that sort of risk tolerance, and then you can use a phase-in approach, and you buy it in and phase it in into the market. So it's a bit of both. It's discussions with your client as well in terms of how to deploy cash at this time.
Yeah. I think I'd like to add to that is all clients say they're willing to take risk until their portfolio is down 20%. then the rubber really hits the road. So, just instinctually, you have to say, if you bought at the current prices, in 5-10 years from now, you're not going to care, if it went down another 10%. But again, it's a very hard pill to swallow if you buy today, you're down 10% next week.
Yeah. I lost my train of thought. But I'll just comment on that. Yeah, it's 20% down. You would think if these were good quality companies 20% ago, being 20% down, it's obviously a lot cheaper. And like you said, in the long run,
material.
It's immaterial, but it's dealing with that stuff on a short-term basis that really gets to people, and it's not easy. You can't ignore that either, right?
No, you can't ignore the behavioral side of things, especially, because people are used to things going up, here and overseas. We haven't had this type of thing apart from COVID, which, is a very, very sharp downswing and very quick upswing. So by the time you got your next portfolio statement, you were fine, So, it's also, we need to look at the behavioral side of things. What we really don't want, is clients to panic and change their strategy at this time, because, it is the fastest way to erode wealth, to actually move out of those strategies. So we do need to be mindful of that as well if we're putting more cash in.
I think, the comfort that I've got from this conversation is the lens that you applied pre-crisis, pre-20% falls, is the same lens that you would apply now, right? So the process doesn't change. It's just the valuations are different. That's all, right? There's no knee-jerk reactions happening. Maybe you're chatting a little bit more about things, but the meetings are still going on. The data is still coming through. It's the process which are tried and tested, which is what will get people through this in the long run. Right?
Yeah, absolutely. I think the worst thing you can do is, we suddenly start to panic, and, portfolio managers are also human. There's also a behavioral side of, things here, which is why you really do need to have a team. So, if I wake up in a very negative, bad mood, I've got Mathew who pulls me, out and kind of slaps some common sense into me. So the teamwork is very important. And I think, we've got a great team.
Just in terms of that team, so my understanding of how it works is there's a house view, right? But you guys are allowed a bit of discretion either way, but you're still accountable for that discretion, right? There's not just, like you say, you wake up in a bad mood and you're hating on Eskom, so you go and make some, I don't know, rash decision buying something, you know, it's not as easy as that, right?
No.
No, yeah. So, I mean, we've got our house view, which we come up, the portfolio manager has a little bit of discretion around that, but every share that is in it goes through a committee. So even though the portfolio manager's got discretion and might like, you know, let's just use, I'll just throw any share out there, Apple as an example. Apple still has to go through a whole committee and scrutinize before it gets put in. So let's, for example, assume that a particular PM likes Apple. It still has to go through the process and it still has to be vetted by every PM before that PM is allowed to put it into the portfolio. So that sort of just is a checks and balances on that sort of share. But the overarching thing is, you know, every portfolio always goes back to the mandate, to the investment objective and to your plan, Mark. So that's the first sort of port of call. And then sort of only the last sort of layer, well, the last little bit is the portfolio manager's little bit of discretion that he or she may put on top.
A little bit of flair that you like to throw on there.
That little bit of flair, that cherry on the top.
No, I'd like to give an example of that. I think the one we get most often is Tesla. You know, why don't you have Tesla on the portfolio? Why don't you have Tesla? Well, the reason we don't have it is, you know, because I think most of us have got common sense. But, you know, if it did go through our portfolio process, it would, well, we've got a certain amount of common sense. If we took that to our committee, the likelihood that that company would get through that committee is really very, very slim. You know, there are a couple of us in our fundamental, you know, tick boxes that it just doesn't meet. I think management is one, debt is another, sustainable earnings is another, even though it is a phenomenal, you know, it really is a phenomenal company. So, you know, that would never be on the portfolio manager's discretionary list. That said, you've got some clients who've got it. I'm sure Matt's got some clients who want it. This is why, again, you have a share portfolio, not a unit trust, because a client has, you know, a certain amount of input as well. Well, they have a lot of input. You know, so what we do is we often get clients who say, we hear all your arguments against, we've heard all the arguments for, but I still want a little bit. You know, then we do put it on the portfolio, and you know, we obviously need the client sign off to do that. If the company does well, you know, it was my decision to put it there. If it was badly, it was the client's decision.
Yeah.
But you know, as a client, you also have input there. You know, we'll give you our opinion though.
Yeah, I think that's the message. Is there's a house view that's gone through a rigorous process. PMs have their little bit of flair, but the client's also got to say, right? It's as much, well, it is their portfolio, and they can bring things to you guys and say, we've heard this, we like this. You know, we've got a client, Caroline, remember before COVID, he wanted in on Norwegian cruise liners, and you were like, oh, no. And thank goodness you said no, and he listened because COVID, right? The business nearly went under. Yes, they're recovering, whatever. But I think that's the thing, you know, you can come to you guys with these things, and you guys will do the research, the due diligence, you'll put a view forward. Ultimately, the client has as much say as what you do, even more, right? If they insist.
Yeah, absolutely.
So 5 minutes. Sorry, I want to press you. I'm not going to ask you for the rand. I'm not going to ask you for the oil price. But you know, looking forward, local or global, where do you see? And just assume there's no client specifics and whatever. There's where do you see better opportunity or safety, or what's your view?
Yeah, so I think you've got to look at the risks that are out there, but you've also got to be mindful that inflation is also a risk to your portfolio. You know, so we look at the horrors that are happening in Europe. We look at the uncertainty in South Africa, and you just want to do a Ramaphosa and put cash under your mattress. It's never a good idea. Never a good idea. But just even from an investment point of view, that's never a good idea. So, you know, it really is client dependent. There are opportunities in our bond market. There are nice yields there at the moment, really, really nice yields. And equity, you know, is ultimately, equity is what's going to give you that long-term inflation beating returns. As long as you've got the time, you know, to sit through the volatility. I think look at the underlying companies you're in. It doesn't matter whether they're listed in South Africa or they're listed offshore. We've got some very, very good companies here. And then just really have the portfolio built, according to, the way we actually do it. So I think equity is going to give you a nice return going forward. It's not going to give you those 20-30% returns that you've had in the last few years, because those are outlier years. But it's still over time going to give you that above inflation return that you need.
So you're just going with equities, right? You're not going to put a finger on.
No, look, I'm an equity person. I always have been, but I also understand that you do need to risk mitigate in your portfolio. So alternative asset classes like bonds and enhanced cash property, definitely do have a place there, which is why I'm very heavily reliant on the broader investment team, to give us guidance as to where we should go.
Yeah, I mean, I pretty much agree with Caroline on all of those sort of things. All her points, long-term sort of equity between local and offshore, exactly as Caroline said, on the local JSE, there's some brilliant, well-run, exceptional businesses on there, just like on the offshore. I think it comes down to having a balance and the right asset allocation for the client. And generally that's how the plan is developed, Mark. Your plan comes out to the right asset allocation for that client in terms of where they need to be based. And then we take our lead from that.
So there's no silver bullet, guys. There's no 100% global, 100% local, equity, cash, bond. It's a balanced approach based on what your plan says you need from a return perspective, and then what's the best way to deliver on that return. What's the asset allocation, the optimal asset allocation that will give us that return profile in the long run?
There probably is a silver bullet, and that's your plan, right?
Yeah.
That is the silver bullet. That's what it is.
Yeah, that's exactly what I was going to say. And the silver bullet is sticking with the plan unless there's a real necessity to change it. And that is what's going to keep your returns high or above inflation long term.
All right, guys. Thank you so much. I've really enjoyed this. I've gotten a lot more insight than I had previously. Thanks a lot, and maybe we'll do another one of these sometime soon when there's less craziness going on in the world. Thanks, guys.
Thanks, Mark. Thanks everyone
who attended.
Thanks,
really appreciate it. Thank you.